If you've ever sat in a leadership meeting and heard terms like FTE, CapEx, variance, net patient service revenue, and you felt like everybody else knew what was going on except you, then you're not alone. I've worked with a lot of nurse leaders who were excellent clinically, but they never got any formal training in finance, so all of this sounds like a foreign language to them. In this video, I'm going to break down 10 finance terms that every nurse leader needs to understand, starting with some staffing terms, then discussing how money moves around the hospital budget, and finally, some of the ways that finance evaluates our performance. Let's start with one that trips people up the most, FTE. It's one of the most important concepts and terms to understand correctly for staffing, the main kind of use of FTE. And FTE stands for, it's an acronym, and it stands for full-time employee. Nope. That is wrong. That is absolutely wrong. It is not full-time employee. It is full-time equivalent. This is very important to understand what this means. An FTE is not, okay, it's very important that you understand it is not a position. Also, not a person. Okay? It's actually a metric. It's calculated. It's a metric that helps us standardize how we determine staffing needs and capacity, because your team is likely composed of a variety of employment arrangements. You're going to have full-time employees. You're going to have part-time employees. You're going to have per diem staff. And FTE lets us normalize all of this down into one numerical expression of the equivalent staffing in full-time hours, right? And full-time hours being defined as 40 per week or 2080 per year, okay? That is essentially the gist of what FTE is. But then the question is, okay, like how do we calculate it? Well, the formula we're going to use for FTE is pretty simple. It is total hours divided by full-time hours. So there's actually two versions of this formula. And so that's total weekly hours divided by 40, or total annual hours divided by 2080. Okay. And this number is just what full-time hours for a whole year looks like. Okay. So that is essentially the formula, but then that kind of probably sounds a little abstract. So let's make this more concrete and look at a realistic example. Let's say I need to staff a 40-bed unit. Okay. And we're a med-surg unit, so it's 24 hours, 7 days a week, 365. How do I figure out, like, how many nurses do I actually need? And this is where FTE actually comes in. So let's kind of lay out, we have to make a couple assumptions here. Let's assume that the 40 beds are always full, just for simplicity of the math. And we're looking for, let's say, a 1:5 nurse to patient ratio. So what that means is that 40 beds full, we need 8 nurses to actually meet that ratio. And we're just going to focus on the RN staff for now. Obviously, you need other staff to run a 40-bed unit, but we're just going to focus on this for simplicity. And we're going to use weekly numbers for easy math. So how do we actually go about calculating this? Well, it's actually pretty simple. So we actually need to do this 2 different ways, though, before we dive into that. We need to calculate first our needs. How many do we need? And then our capacity. Okay, and that's 2 different calculations, because that's how many RNs we need versus how many we actually have. And this helps us kind of figure out whether we're staffed appropriately. So let's dig into it. Let's start with the needs, right? How do we figure out the needs? Well, we're going to start with hours, right? So 24 hours in a day times 7 days in a week, okay, times the number of nurses we need based on our ratio. So 24 by 7 by 8, that gives us 1,344 hours of nursing coverage that we need for 1 week, right? So then how do we like turn that into FTE? Well, pretty simple. We actually just divide 1,344 by 40. That gives us our FTE of need, which is 33.6 FTEs. That is our needs. Okay. Now, though, we need to actually figure out, do we have that? Do we have 33.6 FTEs? And that has to be calculated kind of in the opposite direction. We actually need to start with our employees and the positions we have on our unit. So let's do that. Capacity works differently. We actually have to work with our staff. And so let's say that on this unit, we have 52 nurses. Okay, that's more than 33. Does that mean we have enough? Well, actually, it's a little more complicated than that, right? Let's say 22 of those nurses are 36 hours a week. And then we have 19 of them that are 24 hours a week. And then 6 are 12 hours a week. And 5 are per diem. So what does that give us for FTEs? That's the question we have to figure out. How many FTEs of capacity do we actually have? And so the way we do this is we have to take each position and then calculate the FTE for the position and then total it. Okay. And actually, this is misleading. Not a multiplication. It's just we have to turn the position, sum it into a total. So let's kind of walk through this. 36 hours per week. So if we have a 36-hour position and we divide it by 40, that gives us 0.9. So there's 0.9 FTEs in each of these 22 positions. And those 22 roll up to a total of 19.8 FTEs for those 22 positions. Now we kind of do the same math here as we go down each position. So the 24-hour positions are 24 divided by 40. That's 0.6. And so 19 times 0.6 is 11.4 FTEs. Then we have the 12 hours. So the 12-hour positions are 0.3, right? And they roll up to a total of 1.8 FTEs. Now, what do we do about the per diem position? Well, the thing to know about per diems is that they are 0 FTEs. They don't count towards your FTE because typically the per diems are filling in somebody else's hours. So the FTEs are somewhere else, and these people are just kind of backfilling that. So this is a big fat goose egg. So then we total these together, and that brings us to a total of 33 FTEs. So what's that mean? That actually means that we are short 0.6 FTEs. Now, obviously, there's other factors that go into staffing, right? This is just a basic example for the concept of FTE. I'm not even considering things like what shift these people work or, other, factors like time off and, sick time and stuff like that. These are all some of the other factors that go into staffing. And that's too complicated for this video, but the basic idea being of FTE, this is the utility of the full-time equivalent as a metric and a concept you should understand as a nurse manager, because it provides that standardized mathematical model for determining staffing needs that's independent of the positions and the employment structure and is completely distinct from the next term, which is called headcount, which is actually quite simple in comparison. It's literally the number of people or heads that roll up to either a manager or a department. And sometimes some organizations include vacancies in headcount, and some don't. So depending on your organization, your vacancies might count towards your headcount. So this is actually kind of half HR term versus a finance term. But it's important because we need to make sure it's differentiated. Like it is not the same as FTE, right? And that's really important. And you can already kind of tell from the example we had, like we had 52 RNs in that previous example, but we had 33 FTEs, right? So 52 in some sense would be our headcount. So let's kind of extrapolate this out to another concrete example. Let's say I have a team that is 43 RNs, right? I have say 24 aides, and then I have like maybe 2 like admin staff on the unit, and there's also 5 vacancies, right? So depending on your organization, you might be counting this without the vacancies, and then that would be 43 plus 24 plus 2 gets you to 68 is your head count. Or if you're including the vacancies, then it would be 73, right? Because you add the 5. So that is head count as a concept. So that's a pretty simple one. Now let's talk about spending money. Fun part, right? Spending money. And specifically, we're going to talk about OpEx, or essentially just that's a short term for operating expenses. Okay. Operating expenses is usually an entire section of your annual budget and a really important aspect of your monthly financials. So this will be in your budget. It's going to be in your like what they call a P&L or your operations statement. And it's also going to show up on the high level sort of org financials, such as the operations statement or a cash flow statement. You're going to see this stuff as operating expenses. And this is the money that we spend to keep things running. Okay. We're running the unit with this money, these operating expenses. So it includes things like salaries and benefits, often those will be separated, but it's the same concept. So salaries and benefits, utilities, right? So paying the bills, keeping the facility running, service contracts for your equipment, right? Stuff needs to be maintained. And sometimes that's a vendor and we're paying them, and that's an operating expense. And then supplies and inventory, right? Keeping things stocked. That is an operating expense. So these are all things that are included in operating expenses, and they are differentiated from non-operating expenses and capital expenses. Okay. So non-operating expenses are the things that like we have to pay, but they're not normal ops, right? It's not actually what we are doing to run the organization. So some examples of non-operating expenses would include things like interest on a loan. It would include fines or penalties from the government, for instance, or a settlement in a lawsuit. I'm realizing that I picked some very negative examples, but they're examples because they're good examples because they're clearly not things we expect to continue to pay over time to keep things running. We're not in the business of paying fines or settling lawsuits, but they do happen. And so they're expenses. Now, a lot of times nurse managers are not like, you're not going to see these very frequently, but you should understand the concept. And then there's capital expenses, which are also called CapEx. Again, just a shorthand term for capital expenses, which are also expenses, but these we consider investments into durable equipment, my really bad drawing of a wrench, or like real estate, or other like large assets. And the key thing about these large assets is they depreciate in value over time, and they may eventually need to be replaced. That is what a capital expense is. And they're typically going to be subject to an approval process, and they are counted against a separate capital budget. Okay, so the organization sets aside money specifically for these large sort of planned purchases. And that helps kind of make sure that we're planning for these large, big spending events. So many organizations have a like dollar amount threshold that they'll say is like anything over this amount is a capital expense and has to go through the approval process, right? But it's important to understand that even if that's the case, it's the nature of the purchase, not the dollar amount, that determines if it's a capital expense. So here's an example. Let's say your organization says anything greater than $5,000 is a capital expense. But then you also then spend, let's say, $15K on a travel nurse contract. Is that a capital expense? No. This is still an operating expense because you need that travel RN to, presumably to run operations. So even though the dollar amount is over the threshold, it's not really a capital expense because it's not the right kind of thing. So examples of what would be a capital expense include things like hospital beds, mechanical lifts, automated dispensing cabinets. Also, we call them, by their brand name, the Pyxis machine, or there's other brands as well. But example of that. And then things like buying or maybe constructing or renovating building. All of that. Wow, I don't know what that word is. Forgive my spelling. But all of these are capital expenses. And so you want to just think about, like, if it depreciates in value and it might need to be replaced, then it's probably a capital expense. And that's because all of these things are treated differently by accounting using a process that's called depreciation. Okay. And this is actually pretty simple. This is how finance calculates the decrease and loss in value over time and the need to replace that asset, right? And this is how we do that. So what ends up happening is each one of these capital purchases gets assigned what's called a useful life. And then what we do is we take the value, the purchase value, and then we spread that out over the course of that useful life until we reach the end of the useful life. So to pull this together, it would make the most sense to really look at OpEx and CapEx examples together. So for that 40-bed unit, let's say this month's finances include these expenses. You've got $525,000 in salaries and wages. You've got $145K in benefits and payroll, medical and surgical supplies, $90K, and so on, right? And then at the bottom line, that makes all your operating expenses $935,000 because you sum them all together. So there's your operating expenses. But then let's say you actually also spent $120K installing ceiling lifts in 8 rooms. Why isn't that included in these expenses? Well, that's because this is a capital expense. Okay. So what's going to happen is finance is going to assign this a useful life, let's say 10 years. So then they're going to take that 120K and they're going to spread it out over those 10 years. So let's say like 12K per year or 1K per month. And that is going to then be the expense that is calculated. And it's not going to still be listed in the operating expenses because we're not paying, we're not buying lifts every month. Like that's not part of how we run the unit. But we do have to account for the fact that we spent the money and that value is going to go over time. And then it also helps us to plan for eventually replacing it when we need to. So that is essentially the difference and a practical example of the difference between capital expenses, operating expenses, and the concept of depreciation. Now, as a nurse manager, you're not likely to be responsible for calculating the depreciation, but you do have to understand how it works because it's actually how we plan ahead for replacement and account for these large purchases without confusing ourselves about what it costs to run the show. So as you can tell, there's like a lot of numbers that fly around in hospital finances. So how exactly does finance keep track of it all? Well, that's where the next few terms come in. First of which is cost center. This term represents a business unit or a hospital unit that generates expenses. It spends money. Okay. And like all areas spend money, but the main difference here is that generally it becomes a net cost or expense instead of generating revenue. That's not a rule, but in general, that's the generalization. So most nursing units are cost centers because we spend money and we don't generally generate revenue. So sometimes the cost centers align with the department structure in an organization, right? So you might have a department, and each one has its own cost center. Other times you have a department and it has like several cost centers that roll up to it. And that really depends on how the organization is set up and how they really define everything. You'll also note that in your like finance, like database system, you're going to likely have like a cost center ID code, like a number, and it might have its own name. And you're likely to memorize these. Like when you manage a department, like you end up knowing your cost center or cost centers, by heart. And that's just something that you remember because this is how you actually like plug in the data and figure things out in the system. So that is the idea of a cost center. And it's very related and very similar to the next term, which is revenue center. And it's basically the same idea, except in this case, it's a business unit that generates income or revenue. Earth-shattering, I know. But basically in healthcare, this typically is aligned with like professional services that bill patients or their insurance companies. And then that is how they generate revenue, right? So examples of this would be you have a orthopedic surgeon, right? He does a surgery, bills the insurance company, and that generates money. Okay. Or you have, say, a cardiologist who does a cath procedure. They bill the insurance company, that generates money. Or GI does the colonoscopy, bills the insurance company, that generates money. All of those things these would be examples. And often what happens is that the revenue centers get aligned by individual providers. So like each individual provider who does procedures or sees patients And this is also true of, like, say you have a neurologist who does a consult in the hospital, and that also same thing. He's going to bill the insurance for that consult. That's going to generate revenue. So often in healthcare organizations, each provider is a revenue center. It could also be something like a retail pharmacy or like the gift shop, and they make sales that generate money of actual products. So those are examples. And the idea is that the revenue centers generate the money that offsets the cost centers that are spending the money. And all of this is helpful on an organizational level because finance wants these two things to match up. That is one of their big goals, is to match the revenue to the costs. So it's also helpful understanding that these are part of a larger concept called, it's our 8th term, responsibility centers. And that's the same idea. And basically, it's just the buckets that we divide all the money in depending on where it flows. It's like the umbrella term for cost centers, revenue centers, etc. Because this is how finance keeps track of how the money is coming in, how the money is going out, and etc. Right? No matter what direction it's going in, we need a way to keep track of it because it prevents us from like duplicating something, like counting it twice when it only happened once, or other like deceptive practices in accounting. So that is essentially one of the main reasons why those things exist and why we have cost centers, revenue centers, etc. This concept of cost and revenue centers is also helpful when we're evaluating things, right? Because it kind of helps label the expected outcome, right? So if a cost center comes in the red, right? They're losing money. That might be expected because they're going to generate costs. Now, on the flip side, if a revenue center is losing money, this is probably not expected, right? Because generally we would expect this to be in the black, generating money. So something is wrong, either with the operations, so like actually the way we're running the business, or something's wrong with the books. And so this is kind of how finance is using these things to understand how things are moving around. So that kind of leads to the next term, which is kind of how we track performance. It has to do with that. And it's a term that is kind of, it's a bad rap, and that is variance. We look at variances all the time in finance. And essentially what this is a generic metric that we use as a comparison. We're comparing actual performance versus some sort of benchmark. Most often, this benchmark is budget. Okay. But there's other benchmarks we could use. We'll touch on that in a moment. So the idea of a variance is that when it's not as easy to figure out performance as, revenue is greater than expenses, that's the easiest way to figure out if finances are working. But more often in healthcare, like this really is like not as useful because, like I said before, you might be in a cost center where like you're going to be in the red like a lot of the time. But a variance is really helpful because we can actually compare our performance to what we expect. And that's what this is for. So basically we make a plan, which we call the budget, what we expect to happen, right? And then we compare it to the actual performance, like what did we actually do? And then we express the difference as a percentage. And that is the variance. So let's make this more concrete. let's say for that unit that we've been talking about, we already said that our operating expenses were $935,000 for the month. What if our budget was $950K? Do we have a variance? Well, here's how we find out. The formula for a variance is your benchmark minus the actual, that's in parentheses, divided by the benchmark. That gives you the variance. Right? So let's flesh this out with the example. So we have our benchmark, meaning the budget, is $950K. We're going to subtract the actual performance, which is the $935. That gives us $15K. And notice it's positive $15K. That's important. We'll come back to that. And then we're going to divide the $15K by the budget again, which is $950. Okay. And that gives us 0.0157 or 1.57%. So yes, we do have a variance, and this is a positive number, also very important, right? So we have a variance. It's a positive variance. What does that mean? Well, in this case, seems kind of backwards because we're talking about actual spending versus the budget. If we have a positive variance, that means we beat the budget by 1.57% of the total budget. That's really cool. But if it was a negative number, that would be a bad thing. So that's actually really helpful to understand with variance, is that a negative variance is generally bad. A positive variance is generally good. It may be different depending on the circumstances, but that's generally the case, right? So let's illustrate that by flipping this around. Let's say that instead of spending $935 against a budget of $950, maybe we spent $950 against a budget of $935. So what we would do here is the budget is $935, our actual is $950, and that gives us a negative $15K. Important here. Then we're going to divide into the budget of $935, and that gives us 0.16. Okay, slightly higher percentage because the denominator is smaller. And so then that is a negative 1.6%. Also a variance, but in this case, we outspent the budget by 1.6% of the total budget. Okay? That's what this number tells us. So this is really helpful to understand, is that variance is not necessarily a bad thing. Sometimes in some organizations, people talk about like, oh, we had a variance, and it's like a bad thing. Variance is neutral. It's how the variance compares to the benchmark that you're using that tells you whether it's good or bad. And generally, again, you want a positive variance in most cases because that means you're beating the benchmark you set. You can use other benchmarks for this. It's not just the budget. The budget is pretty common, but there's others that might be used. And often the other most common one is time. So you might be looking at a specific time period, right? So like month over month or year over year, you might compare the variance across years. Or another one that's common is same time period last year or like fiscal year, right? So if it's like May 2026, we might compare to May 2025. And then the difference here would be the variance we're looking at, is like, what's the difference between these two? So in either case, the formula is the same, that you run the benchmark against the actual and divide into the benchmark, and that gives you variance. So it's basically the same idea. The only difference is how you substitute the benchmark. So very useful to understand, but it's also something that is misunderstood. And so that kind of brings us to our final term, which is net patient service revenue. This one sounds really complicated, but it's fairly simple. This is the actual amount of money that we expect to collect from delivering patient care. I really ready stethoscope there. Okay. And we get this number by deriving it from another number. And that is gross patient service charges. And this reflects the amount that we actually bill to the insurance company or the patient, and is generally going to be bigger than net patient service revenue, because we start with this, but then we actually subtract a bunch of things. We subtract all the ways that we don't get paid. So examples would be insurance company has a contracted price that is lower than what we bill. That's called an adjustment. Similarly, Medicare and Medicaid have adjustments. And then we have like bad debt, which is like a bonus term here. In this case, what it refers to is like a bill that we don't expect to collect. So like a certain percentage of people just don't pay their bills. And so we have to kind of write that off. And then there's also charity care. If you are in a nonprofit organization, you probably do a lot of this, right? You're giving away care for free. So let's look at an example here to kind of help us piece this together. Let's say for that 40-bed unit, our gross patient service charges were $3 million, okay, in a month, which is not as crazy as it sounds. Then we're going to subtract a bunch of things, right? So insurance adjustments. I'll do these in a different color, do them in red. So that's going to be minus $1,350,000. And then we have our Medicare adjustments and Medicaid. That's another $650,000. Then we have, like, say, charity care. That's another $120,000 we're subtracting. Then we have bad debt. Let's say that's another $80,000. So that comes out to the sum. We're going to basically just subtract down this line until we get to the sum, which is $800,000. This number is our net patient service revenue, right? So all of this is helpful to understand because you're going to see these numbers on your financials in a nursing unit. So this isn't, of course, going to be the only revenue across the hospital or the organization, but it's a key metric to know. Because on a nursing unit, there are charges that aren't associated with other revenue centers, things like, the room and board charge or the daily charge in the hospital. There's also going to be like nursing care charges. Certain types of things are billed. And then you also have like supplies that you bill for, et cetera. And all of that is part of the gross patient service charges. And then all these other subtractions, and then you end up with this net patient service revenue. And then, of course, this gets like totaled at like the hospital level or the org level. And that shows up on like, the operations statement in the big management meetings. So that is essentially the net patient service revenue idea as a concept. So even though finance can be intimidating, a good chunk of it is just knowing the language and the vocabulary so you can keep up with the conversation. And now you know 10 more finance terms that you need to know as a nurse manager. Subscribe to the channel for more like this.